Time now for our Wall Street Week daily segment. David Westin, the host of Wall Street Week, joining us right now. And David, it's been a pretty wild few days here. And I think when we talk about sort of the people out there who really understand the economy, the people who really understand the markets, providing a little bit of levity, I think, as to sort of what comes next.
Yeah, well, who knows what comes next?
Yeah.
I certainly know what comes next, but it has been a wild week for us to start this Wall Street Week daily segment, actually. We've been able to deal with the banks every single day this week, had Larry on a couple of times. But one of the things that we really want to take a look at is how does it affect that whole ecosystem on the West Coast, that, you know, the Silicon Valley Bank, which started this whole thing, really got us into.
And it's not just the big banks either. There's a lot of concern about these smaller community banks and sort of what the future is for them, and more importantly, what role they have in the economy going forward.
And it's been a critical role, as you know so well, Romaine. It's been really important to the United States economy, and it's a question about what happens next. But we want to bring in somebody now who deals with that ecosystem all the time. She's Afsaneh Beschloss. She's founder and CEO of RockCreek. She's also the former CIO and treasurer of the World Bank, and she was managing director and partner at the Carlyle Group. So Afsaneh, thanks so much for being back with us. As I say, you spend a lot of your time, particularly with some of the climate tech, I'm told they're called, companies out there, the startups that really deal with climate. You know that world. How rough is it for them?
So on Sunday night, obviously, before the news from the Fed, it was pretty rough. A lot of them were clients of SVB and other similar banks. So I think they were all scrambling to deal with cash. But as of obviously today, things are different. In fact, many VCs, including the climate tech ones, are having the wires going back, i.e. payments that you have to make to them, go back into SVB. So a big shift since Sunday night.
So, Afsaneh, does that mean that those companies, by and large, are not having to move away from SVB, or are they moving someplace else? And if so, where do they have to go?
So I think some of those companies obviously learned the lesson. You want more than one banking relationship. So they certainly were expanding their relationship since last weekend. But at the same time, what they realized is some of the terms they were getting at SVB was better than other banks. And also, at the moment, as we speak, SVB deposits are insured. And that is very clear in terms of there's no interpretation needed for that. So at this moment, they're safer. The other thing, David, is the longer term issue for these climate tech businesses, because a lot of what's going to happen with the IRA has to go through the community banks. So their role is going to be incredibly important in the implementation of the IRA.
This is a topic, Afsaneh, that came up a couple of days ago with regards to the community banks, and you've referenced the Inflation Reduction Act. As we talk about the government backstop, if you will, of SVB and potentially of some of the other banks out there, do you think that we could see maybe a little bit more involvement when it comes to those community banks writ large in efforts to pursue those goals that the Biden administration laid out in the IRA?
So I think two sides to that question, Romaine. I think the Biden administration will now have to spend a lot more time making sure that these 4,500 community banks, plus many local banks in the communities that are supposed to be really the lifeline of the IRA to get the money out to the households, are working, functioning, and able to give the loans that they're supposed to. And a lot of the conversations we're hearing in the last couple of days on heightened regulation, you definitely need some sort of regulation, but they have to be implemented with such care to make sure these kinds of institutions can actually operate and do their job well. The other side of the conversation is that the opportunity set continues to be increasing for these kinds of companies. So from an economic point of view, they're in a very good place.
Well, I'm curious. I mean, there's a difference between, I guess, the ability to extend that type of financing, for these institutions to extend that type of financing, and the willingness. And I'm curious how much the willingness will be changed by what we're going through.
I think certainly in terms of that qualitative aspect of their willingness, they're going to be much more careful in terms of just any kind of loan, whether it's a residential mortgage loan or loans to these climate tech related or climate broadly sustainable type companies. I think that is why I keep on going back to the point of how regulators communicate with the community banks and how they communicate in terms of new potential regulation on these community banks to make sure they can play a role while being good bankers. And the other thing that is important is the fact that these community banks and local banks, in fact, had to have better risk management in some cases because they did not generally get saved. And if you look at their loan books, they might be in safer places than many other banks.
Afsaneh, last year, I think it's fair to say, was a rough year for a lot of tech, but climate tech seemed to be an exception to that, in part because of the Inflation Reduction Act, as well as some of the things that are going on over in Europe. As you look at this right now, as best you can figure out, is this a relatively modest speed bump, or could this actually change the course of the energy transition?
So I think it can be just the seed, just potentially maybe, slowing the impact. The bigger issue is if we have a harder landing than we expected because of the events of last week. If, in general, the banking sector, bigger banks, not just community banks, get stricter on lending, if we start having more companies get into trouble as they have the full impact of the higher interest rates impact them, you could have a broader economic impact that would affect everyone, including the climate tech companies, no question. They will be part of the whole ecosystem.
What are you seeing, what are you hearing right now in that respect, specifically credit tightening? It's one thing to say your deposit's okay, you can still get your deposit. It's another to say, we're going to give you another line of credit, we're going to expand credit. What are you seeing in the overall environment out there?
I would say in the last couple of days, banks are holding back and they're being much more careful. And again, going back to the community banks and local banks, we're seeing that they're just being a lot more careful, not just with the clean energy related companies, but generally with their lending. And as you well know, a lot of their lending is based on qualitative factors. So they're kind of waiting and watching to see how things happen and what kind of regulation comes down their way in the next couple of weeks or months.
How much worry was there prior to the current crisis that we're in, particularly with the Fed raising rates and really global banks worldwide raising rates and fundamentally making the case that they were going to stay high, the idea of normalization and that the era of easy money was effectively over?
I think people were incorporating that into their assumptions, but no question that the full impact of if you're not necessarily a good company or if you were not dealing with your finances responsibly, you would go down as interest rates go up, was not fully absorbed. I think some of the earlier segments you've had were talking about the fact that people were so used over the last 40 years to have a very different kind of interest rate climate that it takes a while to get used to the 4.5 or 5% interest rates, borrowing rates for your business. So I think that is really the last week's events brought forward a lot of potential pain that could have come in much slower into a faster track set of pains.
So what's being asked of some of these companies, these private companies right now? Because before, in the past, it was basically grow, 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 and grow at any cost. Is this now pretty much about keeping costs under control, if not just cutting them all together?
I think growth is still very important, and at the same time, having cost efficiencies and having responsible banking, and dealing with your finances in a very responsible way, like other kinds of companies, has become much more part of the conversation. But no question, Romain, that growth is still very important with these companies and to be expected, because if you look at people's consumption patterns, it is moving towards things that are related to clean energy. If you look at the way people are buying cars, mobility, home heating, people are buying heat pumps to increase efficiency of their energy costs. So a lot of what we see in day-to-day behavior is going to translate into higher growth for these kinds of companies. But no question that cost efficiency is now important for every single business, even though supported by venture.
Afsaneh, as an investor, part of your job, and it's a tough one, is to try to look around the corner and see what's around the corner. I sure didn't see this one coming, but it was basically some assets on the balance sheet that were not worth what we were paid for because they were long duration. Where do we have other similar problems? You have a background, for example, with Carlyle. What about private equity? Because you don't necessarily mark to market in that. And are there a lot of losses sitting out there that we should be nervous about when we find out how big they are?
I think, David, what has happened is with private investments, they get marked down on a quarterly basis. So there's a slower markdown. And a number of venture-backed companies and private-backed companies will get marked down We haven't seen their year-end 22 numbers yet. So when we get those in a couple of months, you will see definitely markdowns to those. And you are seeing that with even, what happened with Stripe over the last week or two. You're seeing that with other private companies going to market right now, that people are looking at them on a discount basis compared to earlier. Again, their valuations are still in some cases quite high, but not maybe as sky high as they were before the last couple of months.